All right. How much is too much to spend on a home? One of the most common questions that I get is, how much should I be spending on a primary residence? Well, really, what they're asking you is, how should I balance qualification, which is what the bank will lend me, with affordability, which is what should I be spending on the home each month? I tell clients this: if your housing payment is no more than one third of your after tax income, you're in good shape. If you're spending more than 33.3% of what you take home after you pay taxes, though, you lose flexibility. You can't save as much, you can't invest as much, and every little repair could feel like a true crisis. If we have clients who qualify for more home based on the bank's rules, I will often make sure that they see our adjustable worksheets to really make sure they understand what those payments look like for mortgage, taxes, insurance, etc. I want them to feel comfortable. I love this so much because it's simple and it shows clients that we're also thinking about protecting their lifestyle and their long term financial health. In a market that feels less affordable, maybe it means talking to buyers about looking at a smaller home or slightly lower price point. The key is to give them some perspective though. It's the kind of advice that positions us as the expert and, more importantly, as someone who has their best interest at heart. All right, number two, the Fed has finally made the pivot. Last week, Federal Reserve Chairman, Jerome Powell, made it spoke at the annual conference in Jackson Hole, Wyoming, and he gave a signal that investors have been waiting for. The Fed's going to shift policy. Here's what's going on. Yes, they're still watching inflation, especially with tariffs keeping prices elevated, but right now, they're more worried about a softening job market. And because of that, the Fed is expected to cut rates at their next meeting in September. Yay. The bond market loved that signal. We've already seen rates drop to the lowest level in almost a year. Remember, the Fed has that dual mandate: keep inflation low while maintaining maximum employment. With inflation still above their target, but jobs weakening, they're leaning harder towards protecting jobs. And that's probably the strongest signal yet that lower rates are coming. So, here's where rates are currently. Right now, 30-year fixed rates are right around 6.5% nationally. When you consider that mortgage rates were above 7% as recently as the end of May of 2025, that's a nice improvement. As you have heard, well, as I've said many times, the Fed does not directly set mortgage rates. But the news from last week has continued to improve things. Keep in mind the mortgage rates that your clients typically see move in anticipation of Fed decisions. So when the Fed actually does cut rates in the middle of September, it might not immediately mean lower rates for the consumer, since it's already showing in the pricing that they're receiving from us today. If you are not already, here's my advice: pick up the phone, call your clients, talk to them, let them know where rates have come from and where they are now. Start doing that. More conversations will lead to more transactions. All right? Y'all got this.